traders. A couple of things I want to go through from Tyler Durden over at Zero Hedge that he talks about, and at the top is relating to stocks, which is Walmart can't get rid of its excess inventory. McDonald's is seeing customers trade down. Homes said that order cancellations have doubled in the last 2 months, and new home sales have crashed. Medium prices have plunged and consumer confidence has tumbled, but don't talk about the recession. The much watched 3 months versus 10-year interest rate yield, the spread is collapsing fast, and when that happens, as we can see, you go into a recession not long after, but it is motoring, to be honest. And we'll have a look at the 10-year yields in a minute. They finish pretty much unchanged. However, the yield curve is now pricing in a 13% chance of 100 basis and only a 35% chance of 75 basis points in September. It's pricing in a Fed pivot in December, implying that rates will not be back above that terminal rate for at least a decade. So this is what the euro-dollar curve looked like at the end of May, and this is what it looks like now. So that's getting pretty drastic. Finally, last thing noted is aftermarket in stocks. Microsoft earnings was a miss, and Alphabet earnings were also a miss. However, you look at the Nasdaq, bad news is good news, right? So Nasdaq was, this is a 15-minute chart, okay? Nasdaq was down quite heavily, and then as soon as that news came out, the market rallied. So bad news is good news. So we've got the Nasdaq down for the last 3 days. S&P 500 also down today. Aussie 200 probably will look, well, that looks like a good place to sell the Aussie 200. FTSE pretty much unchanged. DAX is down. China unchanged. Nikkei down. Euro stocks down. Looks almost like the Aussie. And VIX is up a little, starting to creep. What we notice in the commodity markets is a massive spike by natural gas futures, but closing almost unchanged, back towards the low in what we consider the high test bar. Commodity index gapped higher, and oil spiked but failed, back under $100. Looking at iron ore, it was pretty flat. And then the US bond market, as I said, it's closed unchanged, having sort of had a bit of a dip lower, and then a rally. And this weakness in the 10-year bond yield, also 3 months, is screaming higher, gives you that spread that we were looking at. The spread here, so as the 3 months goes that direction and the 10 years goes this direction, that spread goes. Okay, so how does that all look in currency world? Well, US dollar got a bit of a bid, and that's more from safe haven flow rather than any strength in the economy as they tumble towards a recession. So as I said, this week, running into FOMC, it's going to be pretty tricky and volatile and choppy, and I think it's best to be sort of trading the shorter time frames in and out rather quickly, rather than sort of trying to hang on to a long-term view and position. We need to wait until we see what we get tomorrow and what the FOMC forward guidance is looking like, what the dot plot and so on and so forth. So I think it's best to sort of tread cautiously and stay away from that. Commodities, see copper is treading water. There's that natural gas high test bar. Energy index is pretty flat, and I think it too will be pretty tricky as Russia, as the northern hemisphere walks towards winter, and Russia plays the Russian roulette with their gas supplies. soft commodities, a bit of a spike in a few things, but all in all, relatively calm. I think if you're looking for an opportunity, that'd be maybe selling stocks, things like the Aussie looks like a good one. DAX, it's got this triple bottom here, so maybe not that one. And Euro stocks, they'll continue to struggle moving forward. Yeah, so that's it. Just be careful. We're less than 24 hours away from FOMC now, so things will be tricky until then.